Hello everyone, thanks for joining us today for another crypto journey. This week we have an exciting new guest, Matthew Shellcrest from Baker Tilly Accounting. Matthew has had over 19 years of experience in accounting services, specialising in many areas, including cryptocurrency, which he will be specifically talking about with us today. We're very lucky to have Matthew on board.
Well, a very good afternoon, everyone, and thank you, Julia, for the introduction. It's certainly my pleasure to be here with you this afternoon to share some of the knowledge that I've acquired over my years of experience with the crypto space. Obviously, it's fairly difficult times at the moment, being in the midst of a very difficult bear market. So I'm hoping that I can share hopefully some positive news on the tax front to keep morale up, and one way or another we'll come out the other side stronger for it. So a little bit about Baker Tilly. So we're the world's largest independently owned accounting network, and we've got a particular specialty in the crypto space. So over the last sort of 4 to 5 years, we've been building out our crypto capability, and we're probably, in terms of our skills and experience, we'd be certainly one of the most capable firms across the country with regards to the crypto tech side of things. And we have a national crypto strategy where we have representatives from each of our respective offices. I'm based in the Christchurch office, and you can see my smiling face on the top left-hand corner there. As Julia said, for my sins, I've done accounting for 19 years. I've been in the crypto space personally since 2020, but I was advising on some of the tax components from 2018. And it's certainly a big area of my business. Probably 60 to 70% of my clients are crypto related, and basically you name it, I've seen it. We've acted for anyone from large Ethereum whales. We've acted for NFT artists, traders, hodlers, people moving to New Zealand, from New Zealand. So we've seen the whole spectrum. We've also unfortunately seen a number of clients fall victim to various scams over the years. We've dealt with a few clients that have unfortunately passed and trying to recover their crypto holdings as part of their estate process and planning. So we've seen obviously quite a lot, but the thing I like about crypto is there's always more to learn. There's a lot of uncertainty. It's obviously highly speculative, but as you know, volatility is the price of admission, and once you've gone into the crypto space, it's very hard to get back out of that rabbit hole. So supporting me in the Christchurch team, I've got my senior accountant, Natasha Dempster, who basically does all of the heavy lifting and makes me look good. Mike McJury, who is our tax expert, and he has done a number of binding rulings to IRD, which I'll discuss a little bit more later on, because this is a good mechanism of getting some certainty from inland revenue, because as you know, this is a relatively new technology, and regulators are taking a period of time to get up to speed, and the tax laws don't always reflect the reality of what's happening on the ground. And we've got my manager, Kirsten Turner, who makes sure that everything is done correctly from a quality control perspective, and there's nothing that's going to be explosive in there. I guess in terms of my approach to accounting, I've always tried to be very pragmatic and practical, and that's probably what differentiates me from a lot of accountants in this space. like accountants generally are fairly conservative. A lot of them are typically a bit older, and obviously when a new technology comes along, they're probably right to some extent that there's aspects of crypto that are certainly volatile and not what you want to sort of go near. But, there is a lot of gems and genuine projects out there, and I've ridden that wave with understanding the technology, being invested in the space myself, being able to understand the language, how the market moves, and that's made me quite, I guess, relatable to clients, because it is a relatively small, tight-knit community across the country, and I often get recommendations from various sort of Facebook posts and other sort of forums out there. So I'd like to think I'm held in wide regard, and I guess my motivation is really getting good outcomes for clients, and tax is one of those necessary evils. But, we do have to comply at the end of the day. IRD's taking more of an aggressive sort of stance in the space, having dished out a whole lot of funds as part of their COVID response, and crypto's a space that the IRD can sort of see as a way of getting some easy revenue gains. And my role is really just making sure that people are compliant, but we're doing it in a practical and personal way. And I'll discuss that a bit further amongst this presentation. So here's what we're going to be covering. I'll give you a little bit more on my background, the types of investors, touching on the tax treatment, and obviously we're not going to be able to go into everything today, and obviously this is just general advice, so everyone's situation is going to be unique, but I'd like to just give a bit of a high-level overview of what that sort of looks like, and then I'll touch base on the IRD enforcement activity we're seeing out there at the moment. So as I mentioned, 19 years in accounting, started in Nelson, then moved to Queenstown in 2009, up to Christchurch in 2012, and married with 2 children and a wife who is very skeptical of crypto. My children both have crypto holdings, because I couldn't bear seeing their savings account earning 0.25% in the bank. So they hold a couple of Ethereum each, which hopefully when they come to purchase a house one day will be worth more than what it would have been in the bank. And my wife, bless her, she's very keen on the upside, but not necessarily one to appreciate that in the crypto space, patience really is key. And we have a very much a love-hate relationship with how my investment approach to crypto. Funnily enough, she's great at calling tops, which she called on the 11th of November last year. And if only I'd listened to her, I'd probably be in a much better position than I am now. But anyway, it's
very hard to pick.
so she's very pragmatic in that approach, and my goal is to hopefully one day wake up in the morning and say, hey, look, this whole thing that you said was a scam has made us millionaires, and all of the stress and things that I've put her through over the last sort of 4 or 5 years will all be forgiven. So that's my big motivation.
Love that approach.
All I know is accounting. The only other job I've had was delivering pizzas. So I'm a born and bred accountant, been doing it for more than 52% of my life. And my motivation is really helping people. I work for clients, not the IRD. Like the government, we know is only going to, in my opinion anyway, waste our money. So we don't want to give them any more than we need to, but we want to operate within the confines of the rules so that we're not getting unnecessary attention and things. So like I said, very much a pragmatist and just looking for good outcomes for clients, because for me, if I don't know the story of the people behind the numbers. There's not really a lot of motivation there for me. So it's really about people. The numbers are just a means to an end at the end of the day. So as you know, more than 20,000 cryptos out there. Like a lot of, I think 99% of them are garbage, in my opinion.
Yeah.
It's one of those ones where still a new space, highly speculative. I think, we're very much in, if we could compare it to the internet of the sort of early 90s, I think you'd agree,
Mhm.
Julia, that only the strongest will survive, and we've just got to sort of work through what we think by doing our own research has genuine utility and value, and not get swept away with what's getting the sort of wild gains. I think one that's sort of concerning me at the moment is quant being up 100% over the last sort of week or so. Like, I mean, it's just hard to know. I haven't done a lot of research around the coin myself, but if you look at what was in the top 10 this time a year ago, I think we had Polkadot was up at about $50 or $60. Solana was at about 200 or 300. And like those projects now, they really have sort of faded into obscurity, and a lot of that price action was sort of speculative rather than based on genuine sort of development or building. So I guess what I would say, obviously not financial advice, but you've got to know what you hold and genuinely believe in it. Like, I'll leave it to the end to disclose what my favorite coin is,
Yay.
and the risk
Please.
of sort of turning anyone off. And I'll take you through some of the reasons if you're interested later
Absolutely.
on in the session. But there's a lot out there. I think a few have got genuine promise, but it's very much the Wild West, and it'll be interesting to see how this space looks in the next few years. Because if you look at it on this graph, like, this shows the adoption of various sort of technologies and things. And if you look at like the telephone, it had a slow rise. Air travel was a high rise. Cell phones, very quick. Like, I remember getting my first iPhone in 2008, and now you can't live without a smartphone and things. And I think crypto and adoption is only going to continue to increase and accelerate, but we're still very early, at the cutting edge of these sort of things. And I think we get caught up with looking at daily and weekly charts. The reality is, 99% of the world doesn't really know what crypto is and how it operates. And so we're still very early. So you're part of an elite group of people that hopefully one day we're going to sort of reap the benefit of.
Mm.
So one of the most common sort of distinctions when we look at it from a tax point of view is, what type of investor are you? Are you, speculative, trading, whether it's daily or weekly, or are you a long-term holder? And I think one of the key things is it's all about your horizon. Like, I liken crypto, it falls under the property rules for tax treatment. And what one person may think is long term isn't necessarily what the IRD would view. So I've had a lot of discussions with people. They're like, "Oh, I got into crypto in April 2021. I'm a long term holder. Any gains I made, I argue that the non taxable capital gain." The tricky thing with that is, from April 2021 to now is not really that long term. And if you've got any aspect of trading in your wallet, that can muddy your waters. Like, I'll give you an example. We had someone he was buying Bitcoin as it was going from doing that run up from 2020 to, that first top in 2021, and he made about 450K of gains. And he was trying to argue that it was all non-taxable in the sense that he had held it for long-term taxable gain. But the mistake he had made in about October 2020, he had been using the same wallet for a number of trading activities. And if we were to put that in front of the IRD, his argument of saying he was a long-term holder would be totally obliterated, because they're going to turn around and say, well, in October 2020, you were doing all these trades, and now 6 months later, you're trying to argue that you're a long-term holder. So the key thing I would say, if you're trying to run the long-term holder argument, I would recommend you move those coins to a separate wallet. So moving coins between your own wallets isn't a taxable event. So let's say you had some BTC that you wanted to argue in years to come that it's long term. I would move it to, cold storage or something like that, and just leave it there. I would probably also encourage you to maybe send yourself an email saying, hey, look, I'm wanting to protect this asset for long-term benefit. It's going to go into this separate wallet. It's not going to be touched, and then have a separate wallet for your trading activities, because you can have it both ways, where you return the income on your trading activities and you have a separate bag for long-term holdings. And we've had a lot of clients sort of restructure their affairs to do that, because a lot of the time they just have it in one or two wallets or a mixture of wallets, and we don't want to have any muddied waters, because the IRD do have a fairly aggressive approach. Their starting point is that any crypto purchases are taxable, similar to what they view gold. Like gold, inherently you don't get a native return from it. It just goes up or down relative to market conditions. So like with gold, if you're buying crypto, the starting point is the IRD are going to want to tax you on those gains. So I'd encourage anyone to structure, if they are looking to take a long-term view on a few coins, to sort of put that in a separate wallet or a couple of wallets, and have that distinctly separate from their trading bags. And so that's just going to make the argument a lot easier, because in terms of that long-term argument, where a lot of the value comes from, long-term for the IRD is 5 years plus. So if you acquired some coins back in 2020, you can't even consider arguing that it's a lot, taking that any gains are long-term capital gains until you've held them for at least 5 years. Anything before that, you're basically just going to be wasting your time having an argument with the IRD. Our approach with the IRD is that if anyone is trying to take a position that it is non-taxable capital gain, is that will require the client to apply for what's called a private ruling. So the rules as they currently stand is that the IRD says that everything's taxable. So but you can apply to the IRD and say that your situation's unique, and you can get a formal ruling based on your specific set of circumstances. So what that means is there's obviously a cost associated with that, but it does mean that you get some certainty. And if you're sitting on $1 million of cryptocurrency gains, for the sake of us doing a private ruling for 10 or 20K and save you $300,000 to $400,000 of tax, that sort of money well spent. But we're not we've got a good relationship with IRD, and we won't run the argument that it's a long-term capital gain without a binding ruling generally, because we don't want to be filing stuff that clearly could be could put that reputation in jeopardy, because we've got a dedicated line and people at IRD that we can speak to on a no names basis and get some good outcomes for clients. And we value that relationship, and we think it's always good to have, where possible, you want to have a good relationship with regulators, and because you never know when you might need to get a bit of a get out of jail free card. So that's our approach. Is a lot of the time people will take if they've had a gain, we just manage that. But if they're wanting to run something longer term capital gain, we've got a solution for that around that. And sometimes we'll just have clients to us, we'll give them some advice, and then we'll never hear from them again. So we don't really have a fixed way of doing things, but we'll always provide options for what's in the best interest of clients. So on that, Julia, is there anything coming through the chat
Yes.
around this distinction between traders and holders?
We have a few questions, so I'll just go over them if that's okay.
Fire away.
Right, so we'll start with Nigel. Nigel has said, tax packages that work for cryptos in New Zealand, is there a package that covers the major centralized exchanges? Example, Binance, KuCoin, etc.
Yeah, the one that, sorry, I'll let you continue.
And also correctly accounts for staking or lending rewards.
Yeah, all of them can do it, but they don't do them very well. The one that I've had the most experience with is Coinly. So that's Koinly. It is approved by IRD. It has an API that connects with the major exchanges, so it just pulls the data in. You can also upload a CSV file of your wallet to get the transactions. In my experience, it's a good starting point, but you still need to do a reasonableness check on it. So I would always encourage people to have their own records through using an app like Coin Tracker or CoinMarketCap to have their own records that they can compare against it. Because if you rely on Coinly, there's another one called Taxation, which was developed by a Kiwi company. And it's interesting, I've put my data through both, and they do give quite different sort of answers, but the IRD, they generally are pretty acceptable of just taking what's gone through those reports. But obviously you've still got to be comfortable that it's got some bearing to your reality. But I usually use that as my starting point, and then make adjustments based on what I know. And what we find a lot of the time is clients, they've got into the cycle where they started off doing a few trades, getting it, it's quite easy to account for. Then they might have used bots, or they started, using multiple different things, and all of a sudden it's got totally out of hand. And that's where my pragmatic approach comes into it. Is sometimes what we'll do as a starting point is we might say, well, what did you put in? What's it worth now? That'll give us a pretty rough idea of what the gain and loss was, and then we'll put a mechanism in place to try and do a better job of capturing it going forward, because otherwise we get paralyzed where you'll just never know what the gain was. It could be anything, and it's better to do, in my view, it's better to do something than try and do nothing. And we had one client, he did about 70,000 trades in 1 year. But it's fortunate for us, he was on the spectrum and had a very detailed record keeping, which was it was a beautiful thing to see. But most people, it's just an absolute dog's breakfast. And I'm guilty of that myself. Like in the run up to the second top in November 21, there was stuff going left, right, and centre, and I had no clue what was going on. So it's not easy to not easy to sort of keep track of, but so I can definitely relate. What else we got there, Julia?
Right, we've got, thank you, that's great. We've got Paul, and he said many tokens, especially ETH, have a number of uses. Example, validating, liquid staking, gas. The purchaser can acquire them for different purposes at different times and different prices.
Hmm.
Are these taxed differently on disposable,
Yeah,
given
very.
that these will be purchased at different
Yeah,
prices? How is
very,
capital
very
gains?
good question. So
Mm,
again, this is where I look at what your intention was at the time of acquiring it. And this is where I say it's always very good to have a record of what your intention is and having a good structure in place for capturing those transactions. So if you were, if you were buying some ETH for long, you were going to put it into a liquidity pool for the long term, I would be inclined to have that set up through a different wallet, and I would, do something as simple as just sending an email to yourself and saying, "Hey, look, I bought 2 or 3 ETH on this date. I put it into. This is my plan. I'm going to put it in for long-term staking." And then at least you've got something that in years to come you can wheel out to IRD and say, "Hey, look, 5 years have passed since I bought this thing. Here's my intention." You can't dispute an email train that's time stamped.
mhm.
It sets yourself up in a much stronger position, because the tricky thing
Oh, yeah.
is, if you've got everything just going left, right, and center, the IRD's always, because unlike the criminal system where you're innocent till proven guilty, with the IRD you're guilty, the onus is on you proving yourself innocent. So there's just little things that you can do to set yourself up. And if you're just communicating and documenting your intentions, your future self will thank you for
Brilliant. Thank you very much. This is great advice. It really
it.
is.
Yeah.
And okay, so Mark would like to know, gains are only taxable if you sell your crypto.
Well, that's a very good question, Mark,
Mhm.
and you are quite correct. So the taxable event only happens when you realize the gain. So what I mean by that is and I've actually got a very good example of that in a later slide,
Right.
which we can talk through it. So, buy 1 ETH for $2,000.
Mhm.
The taxable event only happens when you dispose it. And the key thing is, in terms of disposal, what I mean is it's not when you convert it to fiat, it's if you dispose it from one coin to another. So if you dispose the ETH for a stable coin, that has locked in the gain. So one of the common misconceptions I have is that, it's only taxable once you withdraw it to fiat. It's taxable once you've converted it from one coin to another. So if you're
Mm.
going from ETH to USDC or converting it to BTC, that is when the taxable event happens. So we've got quite a few clients who, they might have bought stuff back in 2016, 2017, 2018. They're sitting on these large unrealized gains. And you're exactly right. That's only taxable once you actually convert it to another coin.
Great. Yes. Wonderful. Okay, so Lloyd, what are the tax differences between holders and traders?
Yeah, so that's a good question. They're both, in the eyes of the IRD, they're both considered self-employed activities. So I started off when I did my first purchase in September 2020. Like, my whole thing was just, long-term holding, just accumulating. So when I filed my tax return for the year end of 31st of March, I'd only been doing purchases, but because it's still considered a self-employed activity, I was still claiming expenses such as exchange fees, such as home office costs, and those bits and pieces. So it'll only be once, longer term, when I come to argue it's a long-term capital gain, that I'll need to sort of get a ruling to argue that. Traders, you've got to return all of your income and losses. So a lot of people, the IRD does a lot of talking about having to return income, but equally losses can be claimed as an expense. So you only need to return your net trading gains or losses. And obviously you incur, like with any type of business, if there's expenses that you're incurring to derive that income, such as, exchange fees, gas fees, computer expenses, antivirus, any training activities, all of those, as long as they've got a strong relationship to the income, can be claimed as an expense to lower your taxable income. So a lot of people, don't always appreciate that too. So there are things that we can do to mitigate the taxable activities and things. But I just treat it like, being a share trader, having any other business, being a trader.
Okay, great. Right, we're getting a few questions, which is great.
Yes, this is good.
Yeah, it is. It's wonderful.
Good to see
So
people are listening.
yes, instantly, I'm sure. So for trading perpetual contracts, is a tax liability simply a matter for non-profit loss at the year end rather than individual trades being a taxable event?
It's a tricky one. In the eyes of the ID, every trade is a taxable event. And this is where the exchanges don't do a very good job of calculating your gains and losses. Like, a lot of the time, they'll give you a 7-day gain or loss. And that's where the likes of Coinly is quite useful, being able to connect it up to the exchange, and it'll keep a running balance. But in theory, if you did the calculation on a daily basis, using that would be the same to what your annual gains and losses would be. But it's based on every transaction, which is why it's obviously hard to can be hard to keep track of things.
Wow, okay. The next one. When the US global regulations come in the next few weeks and the speculative value is replaced by utility value, bringing
Mm-hmm.
less volatility, am
Yes.
I right in saying borrowing against your assets, hopefully New Zealand banks and FIs won't drag their feet, is an effective way of releasing capital without generating a taxable event?
That's a very good one. That's a common one that we see quite regularly, where
Ah,
you'll put your funds on, you'll use your crypto as collateral and then get USDC, which you then convert to NZD. And because you haven't disposed of the underlying asset, you're not locking in
ah,
the gain. But just make sure that, obviously, with the fallout of Celsius and things, we've had a couple of clients. He had a couple of BTC that he was using as collateral, which is now gone. And so that's always the risk, I would say, with using any time you've got your funds used as collateral, is that's the risk that you have. Is, yes, you don't lock in the taxable event,
mhm.
but you still carry the risk of something happening to the exchange. And he's with Celsius, and he's just not going to see it at all. One thing that we are looking to do to provide some relief, in case there's anyone in the audience who's been caught out with
Yeah.
that, is there is a concession within the tax legislation that if you lose crypto as a result of fraud, you can get a tax deduction for that. So we
Oh,
are considering that, because I suspect as the bankruptcy proceedings go through the courts in the US, it's going to become fairly obvious that Celsius fiasco was a result of fraud, and at least we can limit some of the damage. And I've used my crypto as collateral previously to repaint the roof on our house. I was using a combination of Abra and Celsius, but fortunately I closed out of those positions before
oh,
Celsius imploded. There was
yes.
just more good luck than anything,
Yes,
and it's just
timing.
one of those ones where those, they can be attractive, and that's where I think we do need to that's where I think it would be good to have some regulation in the space, so that we don't have those bad actors basically just wrecking the market, because I think that's a real opportunity in basically being your own bank and things. But we've just had a bit of a bad run, unfortunately.
Yeah, it was unfortunate with Celsius, wasn't it? No
Yes, it
one
was
saw that
appalling.
coming.
Yes, no.
Okay, next one. Matt said that any crypto purchase is taxable. My understanding is that it is only taxable when crypto is sold, disposed. Could
That's
you clarify?
correct. Yeah.
Yeah.
So the
Yeah,
term.
yeah,
So how I'd clarify it there is, you're basically falling into the tax net when you buy crypto, but you don't have to return anything until you sell it.
Yes.
So what I mean is, so it is taxable, but you don't have to do anything until you sell it. So just to clarify that.
Matthew, was it Coinly that you recommended?
Yeah, Coinly and Taxoshi. So I think it's like TAXOSOHI, and they both have you connect up your wallets, and they're as safe as they can get. So they're not. You don't have to provide your private key or anything. You just create an API link which is read only to connect up to your wallet or ledger and things. So it's safe as it can get, I guess. And the only other thing is to download the tax reports. They have a small fee to download the full reports, which would need for the purposes of your tax return. But obviously that's a cost incurred for a business, so that's tax deductible.
Great. Is wrapping and unwrapping tokens taxable?
Well, this is where I've had some discussion with IRD, because as you know, wrapped ETH technically isn't the same as just native ETH, but they're pegged to each other. So I would argue that there hasn't technically been a disposal, but it's one of those ones where, again, the regulation hasn't caught up with the realities. And it's the same can be said if you're holding USDC and you convert it to USDT. There's obviously a slight difference in the values, but what I do is I just view it as the same, so we don't worry about calculating gains and losses between the conversion of stable coins and things. So I'd probably take a pragmatic approach and say that unless we hear otherwise, that wrapped ETH or wrapped BTC is essentially the same. But I'm sure the IRD would, beg to differ. I just hope they're not on the line.
Are you still part of the New Zealand tax net if all trading is on a non-New Zealand platform?
Yeah,
Great
that's
question.
a good question. Again, it all falls down to where you're tax resident. So tax residency, there's several prongs to it. So the starting point is, where are you physically? So if you're living in New Zealand, you're generally a New Zealand tax resident and required to report your worldwide income in New Zealand, regardless of whether the exchanges you've used are overseas. There can be some unique, and this is where my very talented colleague Mike McJury comes into play. We had a very good outcome recently for a client. He was living in Australia, moving to New Zealand. There is a 4-year concessionary rule for transitional residents. So we were able to successfully argue that all of his, because you don't have to return overseas income for the first 4 years when you move to New Zealand. So we locked in all of his gains that he had made in Australia. And so when he arrived here in Queenstown, he had a fully tax-free crypto holdings waiting for him. So there is stuff that we can do, but if you're a New Zealand resident, and you've been trading on overseas exchanges, unfortunately you are required to return it in New Zealand. Like, it is interesting, IRD do contact New Zealand exchanges for data gathering purposes. They don't do it with international exchanges, but sometimes there can be reporting through the banking mechanism. So, the bank may dob you in that you've got these international transfers, and the IRD may be able to find out them and the information that way. So there's lots of, the IRD's got lots of sort of tentacles. So that's why I always say you're best just to be as compliant as, always best to be compliant.
Al would like to know if you were purchasing NFTs for, say, Web3 gaming for in-game utilities such as microtransactions.
Microtransactions.
Could they be considered like assets purchased in a typical Web2 game.
Yeah, it's the same. Like NFTs and things follow the same treatment as crypto by and large. So, if you're buying it for the purposes of, like, let's say, for example, for the what you mentioned with the in-game sort of credits and things, you would, your cost base for, let's say, it was at $100, you purchased it for, and then you disposed of it for 150. Technically, you've got a $50 gain that you need to return to IRD. NFTs, if you were going to hold them for the long term, again, we could run the argument that it's a long-term capital gain. And so again, you'd want to have the same principles of having those NFTs in a separate wallet, documenting your intentions at the time. But it is very murky, and like the current rules don't do a good job of working with that buying stuff for sort of micro transactions. So it's generally, so ID starting point that would be taxable would be my sort of view. But it's hard to, if you're buying some now and you're using it over several weeks, again, it's very hard to know what the sort of actual gain or loss was.
Mm. I think, Matthew, we'll let you carry on.
Yeah, let's carry
Your
on.
presentation, and then we'll go
Got
back to
some
our
good stuff
quick
coming through. So,
break.
like a lot of the stuff we've already talked about through the purposes of the earlier discussion, but again, crypto is treated as property for tax purposes, and again, attention of resale at time of acquisition, and that's where it's difficult, and that means it's difficult to argue an intention other than eventually selling, because the IRD would say, well, it doesn't, like gold, it doesn't, naturally sort of grow in value, which, if you look at staking and things, it's not quite true. So you get these different sort of views, but the IRD starting point is that it's taxable, is what you've got to remember. So staking, they so if you're deriving staking rewards and things, I sort of explain it that it's similar to interest. So the coin that you put on deposit is like putting funds into a bank, and your staking rewards is the interest, and so the interest comes back as income. Mining, your starting point is that all mining rewards are income. They do have a hobby exemption. I'd be interested to know if there's anyone in the chat that's actually still sort of doing much in the mining sort of space, given how high the difficulty is at the moment. Like, I'm always of a view that I'd probably be inclined to save the money on the hardware and just buy the coin outright. But we do have a few clients that do mining. We've got one that does. He's very fortunate that he can mine using solar energy. So, and for him, it makes sense that there's not the same sort of cost and things, but mining rewards are taxable. But equally, because it's a business activity, your electricity costs, your hardware costs are all tax deductible. And airdrops, generally, it really depends. Like, if you're airdropped something that you hold on to for 10 years, you could argue that it's a non-taxable capital gain. But if you get an airdrop and then you just sell it straight away, your cost base is zero because you've received it for nothing, so it's 100% taxable. So that's one that often catches people out, and it just depends on the amount that's at play. And what I'd recommend is, it's always good to have the conversation with us before you do things. Like, we had one client back, and I remember it was on the 15th of May last year, he came and spoke to me, and on the 10th of May, he had exited all of his ETH positions. I think looking back now, it was brilliant. But at the time, I said to him, it would have been really good to have had the conversation prior to the disposal, because it wouldn't have necessarily changed the outcome, but he would have been going into the transaction just understanding a bit more about how the tax treatment was going to work and things. Because a big thing for me is no surprises, and so it's a lot easier knowing that something's taxable if you've had the conversation earlier, rather than it sort of coming after the fact, because there are things that we can do to plan it. And in his situation, because of the amount involved, we got him to pay a bit of tax early, which entitled to him an IRD early payment discount from IRD, which saved him, I think it was about 25K of tax. So there's all this sort of stuff that we can do where we can add value for these sort of things if we sort of know about things beforehand.
Mm-hmm.
The tax side of things is actually, to be honest, is really easy. The starting point is everything's taxable. Where it gets tricky is like, when you're trying to argue that it's non-taxable, or there's something, you're using a privacy coin and it's almost impossible to know what's happened, or they've lost the records, or they started out in 2017 and it's only now that they're doing something about it. So that's where the complexity comes from, the complexity is just the volume of transactions. And, that's where I take, again, I keep using this word pragmatic, but, you really got to be practical in this space. Otherwise you just never get a return filed, and that's not good for anyone. And so it's just about, I think the key thing is just having a conversation. Any conversation I have with people, it's only between me and these four walls. So it doesn't, if you don't want to, like, we have some people where, it just doesn't make sense for them to do anything, because by the time, the amount that they made in gains, they may have lost it all. And then, they might be up for a whole lot of compliance that's not actually going to achieve anything. And we might, I always say, you've got to go through the process and file the returns and things, but they make the decision. Let's go, well, actually, I'm just going to let it sleeping dogs lie. And if I want to do it later down the track, or if the IID comes and speaks to me, I'll deal with it then. And so that brings me something into talking about the IID sort of activity and things. Is the IID will generally always come at you with the view of getting it right. So you may get a letter saying, hey, look, we believe you've got unreturned crypto income. It's usually the form of a letter will turn up, and usually the IID know the answer. They say, are we, you may have, or in case you do, you can bet your bottom dollar that they know, and they're just hoping that they're giving you basically an opportunity to get it right. Because if you ignore it, that's when they can do you for abusive tax position, tax evasion. And what happens with that is, say the tax payable was 10 grand, they'll slap 100% penalty on it. So it'll suddenly become 20K plus penalties and interest. So your 10K could become 30K pretty quick, and that's even before they look at doing criminal penalties. And so the great thing if you do get that letter is to have a conversation, and we can do what's called a voluntary disclosure, where we can put our hand up to the IID and you go, you know what, I stuffed up back in 2018. I now know that I should have returned it as income. We've worked it out. We've used Baker Tilly to work out what it is. We've minimized the tax as much as possible, obviously. Here's what needs to be paid. And what they'll do is, a lot of the time, they'll take the penalties off the table, and they might just charge a little bit of interest. You'll pay the core tax, and we can also minimize the interest by using what's known as tax pooling, which is the real sexy stuff, where we can buy the tax at the original due date, so it appears that if it was paid on time, and then your interest rate is only about 4 or 5% compared to the IRD's 8 or 9. So the voluntary disclosure, it's something we do. That's probably the most common thing we do in crypto. Someone will turn up, they haven't done anything for 4 or 5 years, and you go, look, let's look at it. We work it out, and then once it's all sorted, the tax nice and clear, they can sleep soundly at night, and often the tax isn't as bad as they think it's going to be, because we can, they would have had a couple of good years, a couple of bad years, we offset some expenses, and it just takes a huge, it's very rewarding just getting that monkey off someone's back.
Absolutely. We've got a lot more questions, but I think we'll
Yeah, we'll
answer
keep
at the end.
moving. Yeah, we'll keep going. So tax treatment, a lot of the stuff we've already talked about. Disposals for cash, exchanging one coin. Traders, you can use different methods. So cost, FIFO's first in, first out. So it just gives you. It's the way I'd liken it to. The first coin you buy is the first one that you sell for tax purposes. GST is particularly relevant for NFTs. So we've got a lot of clients artists who create NFTs and things. And what people don't realize is that if you're doing more than $60,000 of sales, you've got to be registered for GST. And the tricky thing is with GST, a lot of when you do your mint and things, you don't know whether they're being sold domestically or internationally, because any NFTs sold overseas aren't subject to GST. So the good thing for our clients from a New Zealand point of view is some of the things we've done is we've got them to use the Google Analytics for the traffic. So we had one drop late last year where the website traffic information said 5% of the NFTs were purchased from people with IP addresses in New Zealand. So we said, well, that's a good practical approach. We'll return 5% of the NFTs for New Zealand GST, and the other 95% are zero rated because they're overseas. And I think if we've got that documentation, it's very hard for the IRD to take exception to that, because you'd say, well, you tell me otherwise. We've got this. We've tried to be as reasonable as possible. But the good thing with being GST registered is you actually can claim any GST for domestic costs, like if you've got computer gear, if you're paying the artist, if you're doing that sort of stuff. So you can actually have a net GST gain, because you're essentially an exporter, and so that can be quite favourable. So GST's relatively, I'd like it. The way I explain it to people, if you're doing NFT art, I would just treat it as if you've got a shop and you're selling artwork. It's the same thing. People come in, they buy it, it's taxable, return GST on it. That's the simplest way I can explain it. Here's some examples, pretty straightforward. Buy one ETH for $2,000, sell it for $2.5, $500 gain. I think that's pretty self-explanatory. The loss, obviously, the flip side: buy it for $2.5, sell it for $2, $500 loss. The key thing with losses is make sure you've got, while IRD want you to have good records, they want you to have really good records when you're trying to claim a loss, because IRD, we'll file a return and it'll have a couple of $100,000 of income. We'll never have a single question about the return. It'll get filed, happy days. The moment we try and claim a loss, which we've been doing a bit more recently, it's getting, the IRD are very, very thorough in assessing the return. So they want to know all of the breakdown and things. So it's you can still claim the loss, but just be prepared for a lot more scrutiny, is I guess what I'd say, because the IRD, they can't have the upside without the downside. Expenses, again, we've touched on a bit of this. It's really looking at what has a strong connection with the income you're generating. Exchange fees, gas fees, if you're using part of the house, computer equipment, accounting fees, that's great. I say to clients, look, we try to, for every dollar a client spends with me, I try to get $3 to $4 of value back in terms of savings and things. So, and it's also tax deductible. So it's happy days for everyone. Shameless plug, of course. Enforcement activity, we're seeing, I think, sort of starting to see a bit of a theme here of, IRD becoming more aggressive. They've circulated all this money out into the economy. They're trying to balance the books. They see crypto as an easy target. the I would say they've moved from sort of softly to probably more just aggressive. Certainly the conversations I've had with the IRD generally, not just crypto related, are becoming a little bit more hostile to what has typically been the case. So it's just bearing in mind that if you've got any sort of skeletons in the closet, um, probably now's a good opportunity to sort of start making moves to sort of get that sorted, because you want to be proactive rather than reactive. I've touched on lots of questions around losses. It's interesting in terms of the knowledge gap. There's a couple of really good people at IID that know their stuff, but as with any government organisation, there's a lot of people that are there because they can't be employed by anyone else, and their knowledge is sort of fairly sort of limited. And when you start sort of bringing out these big concepts and things, it sort of goes over the top of your head. So that's where, again, one thing I would say with the IRD is just be careful if you get a call from them that you're not disclosing too much. It's similar, like if the police called you in for an interview just to have a chat. I'd be very reluctant with what I've shared, because we've had clients who are like, oh yeah, I gave the ID a call, I talked to them about my crypto, and now they've got all of that information on file that can be used as ammunition against you, because the IRD, they've got a role to play, but they're not necessarily, sometimes you could use the wrong, just by the language you use and not understanding the concepts fully, you could set yourself up for an adverse tax outcome. Whereas, like with the police having a lawyer, I'd say with the idea, it's always good to involve, an accountant, just so you know what, the right things to say, because otherwise it can, it's very hard to sort of take it back once it's sort of been said. And that's pretty much it. I know there's still a few questions out there, and I'm mindful of time. Like, I'm in no great rush to get away, so I'm happy to just answer any remaining questions and things.
That would
But
be wonderful.
certainly, if anyone does need to jump off the line, thank you very much for your attendance, and I'm always happy to talk to people. The way I operate is, having a complimentary initial meeting. I've got my Calendly link on the website. If you just go into the website to book a time, we can do it in person, over the video, we can do it, telephone. Like, I'm a pragmatist at the end of the day, and I'm, like I've sort of said, wanting good outcomes for clients, but making sure, you're sort of kept safe at the same time. So how about we get through the rest of those questions, Julia?
Thank you, Matt. Yeah, and I've put in the chat for everyone. I've put in Matt's email address to contact him.
Nice. That's great.
Maybe I can include your phone number.
Yes, that'd be great.
Yeah, great. Okay, so we'll get through the questions. The next one: earning yield through FTX lending is paid hourly.
Mm-hmm.
How do we calculate tax on an hourly yield?
Yeah.
Do we average it over a week or month, etc.?
Yeah. I usually say to people, just whatever's sort of, it's about being consistent. Like, we have a few people who just do a weekly tally, because I think it's a little bit hard just to do it daily. Like, sometimes it could make sense to do it monthly. But it's just about being consistent and disciplined. Like, the IRD would argue you've got to do it hourly, which I think is, impossible. But they wouldn't. But equally, doing it once a year doesn't make sense either. I think just what you can do consistently is the main thing. And if that's weekly, that's good. If it's monthly, that's equally good. But I think it's the consistency is key, and what you can do, and having a sort of smaller frequency, smaller time between times you count it up is best, because you just want, the best quality information at the end of the day.
Great. So, if the average person is expected to track purchases for tax purposes of using their crypto, to say buying a cup of coffee, it seems like we will make the use of crypto as currency very difficult. Is it possible to argue for exemptions for small amounts?
Yeah, that's one of the things that I'd be pushing for in any sort of changes. I think what will happen is it'll probably be moving more to stable coins and things. So what you might say is, let's say you've got a whole lot of ETH, you wouldn't necessarily use the ETH for your purchases. You might sell a block of your ETH for, say, USDC, and then just utilize the USDC for your transactions. I think that's probably more likely for a number of reasons, just around the cost of exchange and gas fees and things. So I think there'll be changes in the regulations as we get more and more adoption.
Great. Okay. Now, Mark, we did touch on this before, but I'll just go over it again. How do the IRD view privacy coins? Because if you can't see the balance, they would probably not be able to see whether it has been disposed of.
Yes, and that's the thing. And that, again, it comes down to you've got to prove yourself innocent. You're guilty until you're proven innocent. And I think a good example I would use is they did it. IRD did it. They periodically do have areas of enforcement. Last year they did it for real estate agents. The year prior they did it for builders and cash jobs. Like, one, I guess, is a good example. A couple of years ago, IRD did some enforcement activity around takeaway premises, and they came up to someone who came to me for some advice, and the IRD just said, well, you've declared $100,000 of income in the last 12 months. We think it was actually 130 because our analysis shows that 30% on average, 30% of takeaways don't, we know that takeaways don't declare 30% of their income, so we're just going to assess you on that basis. So I think it'll be a similar thing with privacy coins, is there'll be other tools, because people have got to understand the IRD's got far-reaching powers. So like a classic one that I say to clients all the time that has caught out a few builder clients over the years is they may be going down to the supermarket each week, flashing their New World card for their groceries. IRD comes along, gets a printout from New World and says, hey, look, Joe's spending $500 a week on groceries at New World, but his tax return only shows that he can, he only makes enough to pay $300, and they'll go, well, please explain where the other $200 a week coming from. So they do all of this sort of stuff that people don't appreciate. So if you're going and buying a new car or you're buying property, all of those sort of things, you just got to think, well, does my declared income reflect, can that support the lifestyle and the purchases that I'm leading? So that's how they do it. And they may not necessarily know the detail. They'll just say, oh, look, we just think it's 200k of income. Tell us it isn't. Is pretty much what they'll do.
Right. Interesting. Okay. Staking rewards in a different coin than what is staked, are they still treated like interest, i.e. taxable on acquisition?
Yeah, that's right. So it basically, if you've got USDC and you're getting yield off it, it's just, you just convert it to New Zealand dollar, the NZ dollar equivalent, basically. So if you're receiving ETH, you just convert that to NZD.
Okay, great. If a coin is substituted by the token issuer, is that taxable? This is a great question.
That's a very good question. I would argue that it isn't. But IRD and maybe some of my contemporaries may say otherwise, because I liken it to the share market. If you have a share split, it's not really, you haven't really disposed of it. It's changed. There has, you could argue it both ways, but, I would sort of say it hasn't really. I'd sort of struggle to say that there has been a taxable event. But again, that's one of those ones where those rulings come into play, because if it's a potentially $1 million tax effect, we'd want to get some certainty in the form of a ruling around that, because it is a grey area.
Mm-hmm. Yeah, there are a few grey areas.
Oh, yes.
Now, Mark, this is a great question too, and something I'm interested. What if I want to gift some crypto to one of my relations? Is it taxable to me when I give it? Are they caught in the tax net when they acquire it?
Great
Yeah.
question. So basically, I'll deal with the recipient because that's the easy one. So if Mark very kindly gifted me some coins, my acquisition cost is 0. So when I dispose of it, it would be fully taxable. But if I held on to it for like 5 or 10 years, I could argue that it's, non-taxable capital gain. So to the recipient, it's taxable, but only once they dispose of it.
Yes.
For the person gifting it, this is where other sort of accounting concepts come into play. So let's say, for example, we're car dealers and Mark gifted a car to a relative, that would need to do adjustment and it would be disposed of at its market value. So Mark would, take the spot price at the time, and if he had paid 5,000 for it, and when he gifted it, it was worth 10,000, he'd still be taxed on that $5,000 gain.
Right.
And that's where it's tricky, because,
Mm.
you gift it, but you haven't received anything for it. But like with other goods and services, you still have. So, one thing you could say is like if you lose crypto, like we had a client and he put $30,000 into a wallet and then
Oh,
lost his passphrase. So he could see it there, but he couldn't access it.
oh
So we
no.
claimed that as a deduction because it was lost. So is there an argument that you could say you lost it?
Mm.
But, that's just pie in the sky sort of. And then your recipient miraculously found the passphrase. So, that's just, I'm not too sure. There's
I
sort of
see where you're going
options
with
options out there.
Yeah.
But that's one where you definitely wouldn't want the ID on this call on that one. That's a shocker.
No.
That's just purely hypothetical.
Yes, absolutely hypothetical.
Yes.
Thank you, Matt. Can a limited liability company who primarily operates in a non-crypto space purchase crypto for investment purposes, short
Yes.
or long term?
Yeah, it's the same rules. Like I've tried to, I've got some other. I'm the youngest director of 8 here in Christchurch, and I think
Well
I
done.
see some funds sitting, earning nothing in a bank account, and I think, why don't we get some crypto in our treasury? It's the same rules. It's if it's held for long term, non-taxable capital gain. If it's short term, any trades are taxable. It's a bit harder from an accounting point of view because you've got to run it through like a set of financial statements. So record keeping's even more important, because for individuals, generally what we do is we just do a wee tax return. So we don't need to keep a record as much detail around what the position of the underlying assets is. We're only generally interested in the gains and losses. So, companies can hold crypto, but it's just got a little bit more sort of compliance cost associated with it.
Okay. We've had some great questions. I'd like to ask one. I'd like to know what coins and a bit about your experience.
Oh
Oh,
yes,
yeah,
my
like
favourite
around the
coin.
cool. Tell
Well,
us about that.
it's very sadly, it's missing from my shirt.
Oh,
Because like I've sort of, my sort of journey, I guess I started off with BTC,
yeah.
you know, got a bit of the kids. I mentioned the kids have got a bit of ETH.
Mhm.
I've sort of mucked around with a few other sort of projects and things, and you know what I've learnt during that last sort of bull run is a lot of those coins and things. A lot of them are sort of fairly sort of very speculative. Some of them have utility. I dabbled, I had quite a big position of Solana for a period of time, but all those outages and things, I've just lost confidence in the project. One claim to fame is I sold Luna Classic 3 days before it collapsed,
Oh,
and so
wow.
that wasn't anything. That wasn't. I wasn't some sort of crystal ball gaze or anything. It was just one of those ones where I got lucky. Like I do like any coin that has utility. And
Mhm.
for that, and this is where I might get a bit of a hate, am a big fan of XRP and what Ripple's developing
Mhm.
there. And I think it's more just because I'm an accountant and that anything, and I sort of have a lot to do with the banking system, and I can see the friction and just how much gets wasted through that. Like we've got a lot of a client that does a lot of work with these seasonal workers that send funds up to the islands, and it's a travesty that these people come down from the islands, leave their family, work hard, and then they go to Western Union and 3 or 4% of their funds disappear for no added value. And so I think that sort of stuff, that's genuine utility. Like I like BTC in terms of a store of value, but the tricky thing is, and I don't necessarily think it's a hedge against inflation. Like it's shown remarkable strength given the macro factors that we've had over the last few months, and I think it'll continue to hold that and grow, but it's sort of a longer term play. And I think, it's good it's a market mover, so it makes sense to have it part of every portfolio. But I wouldn't necessarily say I'd have all of my funds tied up in it. I like ETH. I think the merge needed to happen just to get it a bit more energy efficient, because we're seeing a lot of this ESG concerns and stuff. And the moment, the climate advocates get on things, that can cause a lot of negative effect for crypto. And that's one of the big Achilles heels for Bitcoin, is just its energy use. Like it's getting a lot greener, but it's one of those ones where, people will say, oh, it's dirty, even though the majority of its mining's done by renewables. But it's just, it just highlights how early we are, that people just don't understand it. It's sort of like the internet. People are like, oh, why would I want to email someone when I can pick up the phone or send them a letter? It's just going to take time for a mature. And I think that's where, as a community, we've just got to try and educate people and just do our bit to just fly the flag and help adoption. And and that's where I'm always disappointed where think there's scams and things. Like I got a call from the bank recently when I was trying to buy some ETH, and they said, oh, we're concerned about this transaction on your credit card. And they said, don't you know crypto's used for fraud? And I was like, oh, is cash not? And they didn't really have an answer to that. And so it's just about trying to educate people and things. And criminals are the first to any new technology. Criminals are the first to embrace it. But I think we're a lot more mature now, and I think it's definitely, the next sort of 3 to 5 years is going to be fairly interesting as this whole adoption sort of curve. So I just wish everyone well in their journey, really.
Absolutely. Thank you so much for coming on board, Matt. It's been
No,
such a valuable session.
that's quite all right.
And I want to say, if anyone would like to get in touch with Matt, his email is in the chat. I'll say it again. It's matt.shallcrass. So that's matt .shallcrass at bakertillysr.nz. And his phone number at the office is 03 0599. Sounds like you definitely be able to save some people a lot of money.
Yeah, that's what I'm here for, because if I'm not doing my job.
And we've had a great audience today, so we really appreciate it. You've answered so many great questions, and so thank you very much for your time.
You're most welcome anytime, and look forward to doing it again. Another time. No, yes. and that'll be maybe wealth management, how to safeguard all of your crypto gains.
Great.
Yes.
Wonderful.
Yeah. No, it sounds good. All right. See you, everyone.
Bye-bye.
Take care.
Thank you, everyone.
Bye.